Are you a first-time home buyer? If that's the case, this video is perfect for you because I'll be talking about 9 programs and incentives which are specially made for home buyers in Canada. We'll be talking about the 5% down payment, we'll be talking about the New to Canada program, first-time home buyer incentive, we'll also talk about purchase plus improvement plan, and this purchase plus improvement is one of my favorites, so just stay tuned for this particular program. Then we talk about land transfer tax rebate, the home buyers plan, which is also popularly known as RRSP withdrawal plan for first-time home buyers. Then we talk about the new first home savings account, the FHSA, and then we also talk about 2 tax credits which are important as first-time home buyers, the home buyer tax credit and the GST and HST rebate. This video is going to be long, but it's one of the most important videos when you are buying your first house, so let's get started. Now, before I start the video, I'd love for you to subscribe to the channel if you have not done that already. I can see that over 60% people have not subscribed, but they are seeing the videos. Now, let's talk about the first program, which is the 5% down payment rule, and there is a massive myth around that program. It's not a first-time home buyer incentive, it's an owner-occupied incentive. What that means is, even if you are not a first-time home buyer, let's say you're buying your 10th home and all the other 9 homes are your investment property, you can still buy the house with less than 20% down, 10%, 5%, whatever you qualify for, and we'll talk about that if you are occupying that unit. However, the problem is that not a lot of people will qualify their 10th home with less than 20% down because the guidelines to qualify for this particular loan when it comes to debt to income ratios are very, very strict. Now that it's clear that it's not a first-time home buyer incentive, but it's most relevant to the first-time home buyers, let's talk about the program a little bit. If you're buying to live, you can do a 5% down. The purchase price has to be less than $1 million. It has to be equal or less than $999,999. And if you're buying an investment or a rental property, you cannot qualify even if you are a first-time home buyer. So if you are a first-time home buyer, but you're not buying it for yourself, but you're buying it as a rental property, you will not qualify for the minimum down payment. Now, I know a lot of people already know this, but it's not really 5% when it comes to the 5% down payment. It's 5% on the first $500,000 and then it's 10% on the balance. Now, let me give you an example here. Let's say you're buying a $700,000 house. The 5% of $700,000 is $35,000, but that's not your down payment. You'll be paying 5% of the first $500,000, which is $25,000, and the remainder of $200,000, which is $700,000 minus the first $500,000, you have to pay 10% on that, and that brings up overall down payment to $45,000. Now, I do get a lot of calls from clients saying that, no, my bank is actually giving me 5% on the overall amount. That's not true. If the bank is saying or anyone is saying that I can do a 5% on $700,000 with $35,000 down payment, that is misinformation, so be aware of that. Now, there is a small caveat with this, and you need to talk to a mortgage agent or book a call with me when you are looking to do a less than 20% down, because not everyone can qualify for the 5% or the minimum down payment, even if you are a first-time home buyer and buying to live in it. And the reason for this is the credit score is really important when it comes to doing a minimum down payment, and we'll talk about that in my next slide. And when I say credit, it doesn't always mean credit score, it means the length of credit. Now, if you're new to Canada, there are a lot of myths around buying a house, and I want to bust them one by one. Let's talk about the first myth, which is you have to do 20% down if you are new to Canada. That's in fact not true. You can do as little as 5% for the first $500,000, the minimum down payment, if you have enough credit length, which is at least 10 months of credit. Now, ideally, it should be 12 months, but we might be able to get an exception on 10 months. Again, it's very case-by-case basis, but it's absolutely untrue when people say that you have to do a 20% down because you don't have enough credit in Canada. Now, related to that, there's another myth around credit scores that people say that you need to have 700 plus credit score, 750 plus credit score in order to make a 5% down payment or buy a house in the first 1 year or 2 years of coming to Canada. That is not true. Yes, you need 680 plus credit score, but there is a program which is in fact called the New to Canada program, where you can buy a house with as little as 0 credit score as long as the primary applicant, let's say you are buying as a couple, the primary applicant has 680 plus and the spouse did not actually get a credit card and therefore they have a 0 credit score, you can still qualify for the program. The third myth is that you need 1 year of job before buying a house. That's not true because you only need 3 months of full-time employment in Canada in order to qualify to buy a house even with less than 20% down. Another one is that you can't buy a house on work permit. Now, this was in fact true a few weeks back when there was a foreign buyer ban, but right now there is no foreign buyer ban, but do watch out for the non-resident speculation tax. For example, in Ontario, if you're on work permit, if you're buying a house, you'll have to pay 25 NRST, which is non-resident speculation tax. But if you're buying in Calgary or anywhere in Alberta, you actually don't have to pay the NRST. You can still do the 5% down payment if you're buying for yourself and not pay any tax. And there is no ban on buying if you're on work permit. Another misconception around down payment is you need to have down payment for 90 days in your account. That's not true, especially for new to Canada. If you're new to Canada, you might not have the down payment for 90 days. You might be getting it from India. The important thing is that we need to paper trail all the funds coming from India. And most times it's just easy for the mortgage agent or the bank to paper trail 90 days if it's clean. Now, I have personally looked at clients with over 10 statements coming from India and then other parts of the country. As long as we are able to paper trail and there's nothing illegal that we are doing, it is possible to qualify even if you do not have the money in your bank account for 90 days. And the last one is you can't use gifted funds. That's in fact not true. You need 5% of your own funds when you're new to Canada. However, if you are wanting to do more down payment or you want to cover closing costs with a gift from a family member, you can in fact do that. Now, the important thing to understand is family members only qualify as parents, grandparents, real siblings, and your kids. So under this New to Canada program, you can buy a house at less than 20% down if you have a working status in Canada, ideally a PR, but even if you are on work permit, if you are okay with the foreign buyer tax in Ontario and BC, you can actually buy a house. Or if you are in Alberta, there is no foreign buyer tax and therefore you can buy a house under the New to Canada program. You need to have 3 months of active employment. We already talked about that. And then we just need one active credit card with good down payment history, ideally for all the applicants on the title. Even if there's one applicant with substantial history and one applicant with no history, we can still get you qualified under the New to Canada program. And the last one, which is around the down payment, and I'll not go into a lot of details because this can actually become a very lengthy video only on this topic, but you can do a 5% down payment if you're new to Canada. However, you might be required to produce alternate credit history because even if you're new to Canada and there's a program that's built for you to buy a house, even if you don't have credit score or a decent credit score, you still need to show that you have been paying your bills on time. So we may ask for your utility bills that you have paid on time for, let's say, the last 10 to 12 months. We might also ask for your rent payments that have gone on time or other bills that can prove that you are a credible home buyer and you can handle your mortgage. Now, this particular New to Canada program is actually sponsored by CMHC. We have all heard about CMHC. That's the insurer that most of the people actually know about. But there are two other insurance, which is Sagen and Canada Guarantee, which actually has a New to Canada program. And the reason why I am spending so much time on this is because there is a lot of misinformation around that. And I just wanted to make sure that we understand this particular site if you are new to Canada and we are planning to buy a house in the next 1 year. Now, let's quickly move on to the third program, which is First Time Homebuyer Incentive. I'm sure you all know about this. This is basically Government of Canada providing down payment support, which is 5% of resale. Now, this is not free money. This is a loan, but we'll talk about that in a bit. And if you are buying a resale house, it's 5% that you can take government support on. That's 5% of your down payment coming from the government. If you're buying a new build, it could be as high as 10%. This is basically a shared equity model where you repay at the end of 25 years or when you sell the house if it's less than 25 years. Now, like I said, this is not free money. This is actually something that you need to repay. So the repayment calculation works a little bit differently. It was a lot easier earlier, but now it works a little bit differently. Let's say you bought a house for $400,000 and the incentive that you took from the government is about 5%, which is $20,000. Now, let's say you sell the house in 5 years and now the home value is $480,000. So you actually gained $480 minus $480,000 from this particular sale. Now, obviously, because you took 5% support from the government actually owns 5% equity in the house and you have to at least return the $20,000, but there is more to it that you need to return to them. And the way shared equity calculation works is that if you have sold the house for $480 and then original price of $400, you multiply it by 5%. And that's about $4,000 because 5% is the amount of money that you took. The difference is $80,000. 5% of that is $4,000. So you need to repay $20,000 plus $4,000. However, if you sell the house in 10, 15, 20 years and the property value has doubled or tripled, obviously this number will be a lot higher. This number can be as high as $12,000, $16,000, $20,000. So there's a cap on the amount of returns that you have to give to the government. And that cap is at 8%. For every year. So when you're returning the money to the government, you have to return $20,000 plus lower of these two particular amounts. And you can just go through the calculations. It's very self-explanatory. And you have to return $20,000 plus $4,000 in this case, $24,000 when you sell this house. Now, in order to be eligible for the house, you need to be a first-time home buyer, of course, because it's first-time home buyer incentive. The minimum down payment has to come from your own funds, which is 5%, and then 5% can be contributed by the government. Then household income has to be less than $150,000 if you're in Toronto, Vancouver, or Victoria. For the rest of the country and rest of the metropolitans, you have to have a household income of less than $120,000. And you can buy a maximum of 4.5 times your income. That's the other eligibility criteria. So if your household income is $120,000, your purchase price has to be less than $540,000. And that's something which is very hard to qualify if you are in Ontario or BC, but still pretty reasonable if you are in Alberta. Now, related to this, there are a lot of cities that actually have their own programs. For example, Kitchener-Waterloo has a program where, just like the first-time home buyer incentive, you can loan 5% from the Kitchener-Waterloo region. It's forgivable if you keep the house for 20 years. And if you sell the house in less than 20 years, you need to return back the principal. Let's say it's $20,000 like we had in the previous example, plus 5% on the capital gains. Now, in order to qualify for this particular program in Kitchener and Waterloo, you have to be living on rent for at least 1 year in Waterloo region, and then you can qualify. I'll put an official link in the description where you can check eligibility of all these programs, and you can go into detail or book a call with me and then discuss these programs so that you do not make a mistake when you're applying for these. Now, again, this is not personal advice. It's just my personal opinion. I just feel that this particular incentive, first of all, a lot of people cannot qualify. And second of all, it's just too much that you are giving to the government, which I at least will not be happy with personally. Now, let's talk about the fourth program, which is Purchase Plus Improvement. This is my favorite program of all time. I've done a lot of these mortgages. Not a lot of people know about this. Now, let's talk about what this particular program is. Now, let's say you buy a house with an unfinished basement. Maybe it has a separate entrance, maybe it doesn't, but you can actually finish the basement. And for that, the bank will actually give you $40,000 of improvements loan as part of your purchase. So let's say you are buying a house for $500,000 with a minimum down payment or 10% down payment. Instead of doing $50,000 on $500,000, the bank can actually give you $540,000 with a 10% down, which is $54,000. And therefore, you get additional money to make the renovations, make the basement, rent it out, and have additional income. This is a really good program if you're trying to house hack or if you're trying to buy something which doesn't look as good, and therefore there's no bidding war on that. And then you just use this money to renovate this unit and make it your own. Now, there is an eligibility criteria. The first one is it has to be maximum of 4 units. It cannot be a multifamily home with more than 4 units with at least 1 unit owner occupied. So you cannot just buy a rental property and then use this program. You have to owner occupy 1 unit. And that's something which is really important to understand. And the second one is you have to income qualify. So let's say your overall qualification is $550,000. You cannot buy the house for $550,000 and then expect the bank to give $40,000. You have to buy for $510,000 and then ask for the $40,000 so that your overall eligibility still remains at $550,000 and your overall borrowing is again less than your eligibility. Now, the biggest watch out here is that there are some additional costs that you need to take care of. For example, there will be an appraisal on the property which costs about $400 to $500. It can be more, it can be less depending on how big the property is. And there will be additional legal fees as well because the lawyers have to hold back some funds for renovations and they still need to be involved in the process till the time you actually complete the renovations, then give them the bills, and then they have to complete the transaction. So there is more legal work required and therefore there could be some additional costs. So just budget about $1,000 more in closing costs when you are going for this particular plan. And the other important watch out is even if you're getting the $40,000 loan or up to $40,000 loan, you still need to spend your own money. Yes, you can use your line of credit even if it's unsecured, and then get reimbursed by the lawyer when the bank confirms that renos are completed. And the most important thing here is that you need to make sure you're working with a mortgage agent who has done this before. You're working with a lawyer who has done this before, because the process involved here is really different. It's an amazing program to increase your value. Let's say you renovate your basement and spend about $30,000-$40,000 in renovating it and then renting it out. You will actually immediately increase the value or the equity in the house by about $100,000. And that's not a small gain. This particular program puts money in your pocket, but it's very important that you have the right team together so that it goes seamless. The fifth program that I'll talk about is land transfer tax rebate. That's a simple one. If you're in Ontario and if you're buying your first house, you will get a $4,000 rebate as part of your closing costs. In Toronto, that's up to $8,000 because the land transfer tax in Toronto is really high. If you're in BC, you get a full rebate of land transfer tax if you're buying a home which is less than $500,000, and you get a partial rebate if the home price is between $500,000 to $525,000. And in Alberta, it's not actually applicable because land transfer tax is in fact zero. And like I said, you get this rebate as part of your closing costs. So when you get your closing costs from the lawyer, you will get a minus $4,000 as part of the closing cost, and you'll have to pay less money on closing. Now, this is something that a lot of people don't know. A lot of people know that this is a first-time home buyer advantage, but you have to be a first-time home buyer anywhere in the world. So if you own a property in India or your hometown or in the US, you are not qualified for this particular program. So it's really important that you have the right conversation with the lawyer. And if you are a home buyer anywhere in the world, you do not qualify for this particular rebate. Now let's talk about the sixth one, which is home buyer's plan. And this is one of my favorite. It's a no-brainer in my view. You can withdraw from your registered retirement saving plan, your RRSP, to buy your first home. And you can withdraw this money if you're buying for your first home tax-free. The withdrawal limit is $35,000. If you're a couple, you can do $35,000 per person, and that's a really good thing as well. However, you do need to return this money to your RRSP inside of 15 years. Now, in order to make an eligible withdrawal from your RRSP, your money has to be sitting there for at least 90 days. So if you have put your money inside of those 90 days and you're taking that money out, that will not be tax-free. So make sure that you're putting your money 90 days prior, and then you buy a house and take the money out for your down payment. So a lot of people ask me whether I should put the money into my RRSP for my first time home buying or not. And I would say to them that it's a no-brainer. Let me explain that with maths. Let's say your gross income pre-tax is $100,000 and your income tax on that is $22,427,000. This is just in Ontario. Now, if you are in another province, it will be slightly different. There are many calculators that you can use. So this is scenario number one, where you do not contribute to RRSP. Let's say you contribute $15,000 in this particular year to RRSP. So your taxable income pre-tax now becomes $85,000, because that's how RRSP works. If you earn a certain amount and you make an eligible contribution to RRSP, that RRSP contribution gets deducted from your gross income and you only pay tax, which is way less than what you would have paid if you had not made the RRSP contribution. And you actually save, in this particular example, that would come almost $5,000 that would come as a tax return if you are salaried. Now, let's say you're buying a house, you can use this $5,000 towards your down payment plus the RRSP withdrawal limit of $35,000. Now, you only contributed $15,000. Therefore, your RRSP withdrawal can be a maximum of $15,000. Now, here's where the magic happens. You need to return this money of RRSP in 15 years. But in 15 years, because of inflation, let's assume 3%, it's now worth $9,600 in today's money, because money and dollar depreciates with time because of inflation. And you're using this money to buy an asset which appreciates in value over time. To explain this a little bit better, let's say you give me $15,000 today and I return the $15,000 in 15 years to you. Who do you think would benefit from those $15,000? Of course, it will be me, because I invested that $15,000, let's say in my GIC, and gained, let's say, $5,000 in 15 years. I'm just giving a higher number. But what I'm saying is that if you're getting the same amount of money that I took 15 years before, the worth of that $15,000 today will be a lot less because of inflation. And therefore, putting money into RRSP to buy your first house and withdrawing that money when you're buying your first house is an absolute no-brainer. Now, talking about no-brainers, there's another account which is First Home Savings Account. This was launched in April of 1st. Now, it was launched earlier, but this actually went into effect on April of 1st, 2023. It's also called FHSA. And this is basically RRSP and TFSA in one. Like I explained in the previous slide, you will get a tax rebate because you contribute to this account, but you can take this money out anytime without paying any tax. So it's best of both RRSP and tax-free savings account in one. There is a limit to this. You can contribute $8,000 per year, and the lifetime limit on this is $40,000. An unused contribution can carry forward into the following year up to a maximum of $8,000. So let's say I don't make any contribution today. I can make $16,000 in year 2, but if I don't make a contribution in year 2 as well, I'll still be able to only make $16,000 in year 3. So my first year's contribution is now gone. And let's say you don't use it to buy a house, you can just transfer it to another retirement savings account like RRSP. Now, in order to be eligible for this, you need to be a first-time home buyer, and you need to be buying your primary residence. So you need to be living in that house. Plus, you have to have an agreement of purchase when you're withdrawing the house. And there is a small exception to this, that you can make a qualifying withdrawal within 30 days of moving into the house. So even if you moved into the house and then you thought that, no, I need the FHSA, you can actually do that within 30 days. Now, the problem is that this is so new that no one has the experience of doing all this, putting money, taking money out. And therefore, this is all theoretical as per the official website. I'll put the link in the description, but do it at your own risk. Talk to your bank, talk to your accountant before you're doing this. Talk to me when you're booking a call, and we can just figure this out together. But just know that this is all theoretical based on what's there on the website, and there's no real experience that's talking here. But for sure, this is an absolute no-brainer. You need to put money into this account if you are planning to buy a house in the next 1 to 5 years. I don't know if you're still watching this video. If you are, thank you so much. Do share this video if you are finding it helpful. But let me just talk about the last 2 tax credits which are important to know as first-time homebuyers or as home buyers, in general. The first one is home buyers tax credit, which is basically $10,000 of deduction that you can take in your taxable income when you are filing your taxes. So if you have bought your first house, make sure that you tell that to your accountant and you will get a $10,000 tax credit. If you bought as a couple, you cannot both apply for the $10,000 credit. So either one of you can claim this credit. And of course, this is only applicable if you are a first-time home buyer. The last one and the second tax credit that you need to know about is GST and HST New Housing Rebate. And this is applicable only if you bought a new build like we did, or you substantially renovated your home and it's basically just putting the entire home down and then building it back up, which is essentially a new build again. Now, most times, just like in our case, when we were buying this house, this particular rebate of $24,000 was already included in our purchase price because we were buying for ourselves. But if you're buying as an investment property, you will still be qualified for this. It's just that you will have to apply for this particular rebate at a later date. Now, these were the 9 programs and incentives that you need to know if you are buying your first house. I hope you liked this video. All the official links to all these 9 programs are in the description below. If you like this video, do share it with a friend who can benefit from this as well. And again, do subscribe to the channel and hit the bell icon so that you do not miss any videos on this particular channel. That's all we have for today. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय।